Well, welcome to the Investor Download. We're here today to discuss the topic of microfinance, how it helps grow economies, what it is, and what financial inclusion is too, but also very importantly, how it works on the ground. And we're also going to look at the role it can play in investment portfolios and generating positive returns. Now, here with me today to help explain all this is Hirola Spahio, CEO of NOA. Hirola, welcome to the studio.
Thank you very much.
How are you?
Fine, thank you.
Great, absolutely fantastic. And we've also got Daniel Perot. He's Global Head of Business Development at Blue Orchard, an impact investment manager. Daniel, very welcome.
Thanks for having me.
All right, great. So we're going to start in the first part of the show with understanding impact, microfinance and financial inclusion. So, Hirola, my first question to you is, can you explain what NOA is and what it does?
Yes, of course. NOA, we call it NOA. It's a non-bank financial institution operating for more than 25 years in the Albanian market with a specific focus in financing the smallest businesses, which mainly are family businesses, the families, and also the agriculture sector very deeply on it.
Okay, brilliant. And I hear financial inclusion a lot in terms of microfinance. Can you just explain how that works together and what it is?
Yes, exactly, because we work with that part of the customers, which are the smallest one. Usually they don't have a bank account or a financial product, or their educational level in financial products, it's very low. So our job is to make it as much as possible the inclusion of those part of the customers in order to get more and more visible in the market, grow with their investment plans, and create a sustainability of their small businesses.
Okay, so you're working with individuals on the ground.
Yes, exactly. That's our part of the business.
And I understand the Central Bank of Albania plays a role too.
Yes, we are monitored as a market since 2007 from the Central Bank of Albania. It's our main regulatory body. It monitors the market, it drafts the regulations, and we have also monthly and quarterly reporting to the Central Bank of Albania. In fact, the market of the non-bank financial institutions is the same regulated as for the banking system itself. So they take care a lot on good governance, on good experiences, protecting the customers, increasing the financial inclusion of the customers in the Albanian market. So it's quite a well-regulated.
Yes. So you have a lot of people you have to keep happy.
Yeah.
Okay, brilliant. And how do you measure success at NOA?
In fact, success for us, the success it is to see the smallest customer growing with us. So we have many customers. 11% of our customers today, it is with NOA for more than 5 cycles of financing. So many years with us, and they have started from the small business. Now they have grown up, growing. So in order to make a better life, better living conditions for the family and for their own businesses. So for us, this is the key measure of success. We see our customers growing, succeeding in their businesses, creating sustainability not only for themselves only, but for the environment, because the bigger they get, the more they employ from the localities. The more they employ, the more impact in the families around them, and the more the impact in the small economy of Albania as well. And
I presume you're gathering a lot of data on that too?
Yes, of course, yeah.
Okay, excellent. We're going to get onto specific examples in part 2 of the show, but Daniel, I just want to move over to you now. We mentioned Blue Orchard at the top of the show. Could you explain what Blue Orchard is and what it does?
Sure. So Blue Orchard is an impact investment manager founded in 2001 in Geneva around a specific microfinance investment strategy. All we do is impact investing. So we invest in different asset classes across emerging and frontier markets. And we're a proud member of the Shorters Group since 2019.
Okay, and there'll be quite a few people probably listening or watching that might not know what impact investing is. Can you just give us a broad overview of what we mean by impact investing?
Sure. So we refer to the definition of the IFC, and that is impact investing is an investment that is aiming at generating a positive, measurable environmental and social return alongside a financial return.
Okay, fantastic. And what do we mean, what role does impact investing play within financial inclusion?
So I think microfinance and financial inclusion is a very important topic when it comes to impact investing, because helping individuals and SMEs to access financial services is really helping the local economies to stabilize, to create jobs, as Herjula just addressed that. And for us, it is absolutely part of our DNA, financial inclusion, since our foundation. And over time, we also added climate.
Okay, brilliant. I just want to unpack a couple of things there. SMEs, small and medium-sized enterprises.
Yes.
How big and small are we talking about in terms of their size?
That will largely depend on the countries where you invest in. In Albania, you have probably MSMEs with, it depends on the employees, but roughly 4+ employees would be the type. So very small MSMEs, but very important in terms of job creation, in terms of contribution to the GDP overall in the respective countries. So for us, really the engine of growth in the different emerging countries where we invest in.
And what role does the SMEs play in financial inclusion?
So they are a very big chunk of the employers. As employer, they have an important role. They create jobs. They allow some of the brains not to leave the country because they offer jobs. And they often excluded. We tend to forget that when we discuss financial exclusion, it's not only individuals, but it's also SMEs who struggle to get access to financial services. Okay, so
like you say, it's keeping the intelligence within the country, but a bit like we do here, right? People in companies want to keep the brains in the offices. And how is impact measured from a Blue Orchard point of view?
So I've just said the measurability of the social impact is obviously crucial for our investors, but we have developed since our foundation really an impact framework allowing us to really thoroughly look into the impact which we are able to generate through our investments. So we have a proprietary tool that we use across our investments to measure that, and have a dedicated team that is only looking at measuring the impact of our investments.
Okay, so to bring it all together, how does impact investing and microfinance work together? What's the blend look like?
In fact, we cooperate a lot together in terms of the capital movement, because to finance, you need all the time the capital. What we as microfinance institution, we're all the time searching the capital to enable it within the Albanian market. And in that effort, we get alongside with investors and with investment plans in order to get that excess of liquidity from somewhere else and to bring it, especially in the emerging market when capital is a little bit difficult to be raised in, but the need is much more higher on that.
And what role would a company like Blue Orchard play?
So it works. So we see that the financing we provide to our partners in emerging markets is really helping to support the growth of our financial partners in those markets. And we see that through that we can fight extreme poverty. We can help people to develop an economic activity. So this is why we think microfinance is a high impact strategy that makes absolute sense for any investors that is looking to generate social impact, but also a financial return.
Okay, brilliant. So that's part one of the show. We've explored what microfinance is and how it works alongside impact investing. In part two, we're going to bring it all alive with some case studies about how it works on the ground. Okay, so you mentioned, Herjula, that the typical end client, goes from maybe a family of 4 or a group of 4 up to however many, a business. What are the main challenges that you face?
Yes, definitely our typical customer, it's a small one, either a small family or a small business or a small farmer. But it goes also up to the very formalized companies and which have employed even more employees, so even 100 employees employed on that. And why we serve the whole range? Because exclusion is everywhere. Even a big company, if they don't have enough collaterals to be provided for a bank, it's excluded from financing. So what we do is we try to be much more flexible in serving the whole part of the customers that cannot take a financing normally in a banking sector. Challenges are a lot. Education, financial education is the first one, and especially the lower the customer, the smaller the customer it is, the higher it is a financial education gap. And what we do, it's quite a lot of effort in explaining about the financial literacy and about the implication of a loan as well, over indebtedness, and also many parallel investment plans that can disturb the sustainability of the business. So it's quite an effort for the financial education. The second challenge, especially in emerging market, it is the accuracy of the data. So informality remains high still. So we develop internally with scoring models in order to assess behavior of the customer in the future, because just based on the data that we can receive for the market makes it a lot difficult. The information about the customer still remains difficult because you need to have access, which is not all the time available there. In Albania, the only official source we can have is the credit scoring, so it's the credit registry, but nothing else like that. If we want information about the income of the customer, for example, we have to wait from the customer. If we want about the business income, we need to ask the business for it. So no data shared that can help a lot to develop the scoring for all the typologies of the customers. Digitalization is another challenge recently. Because now the customers are tending and are pushing to get the financial products very fast. So they don't want anymore in the same way the products have been served years ago. So they want fast products, personalized products that fits exactly to the need that they have.
That sounds like a lot of challenges. Dare I ask, how are you addressing those challenges?
It's with basically it's with the human resources, so the teams. We create teams that can all time be dedicated to the customers. We do frequent market researches about the need of the customer, about the behavior of the customer. We do seminars and advisories for the majority of our customers, apart from our financing and independently of the financing, in order to explain ourselves, but also get the feeling from the market what's going on and what are the trends. We are very much flexible in treating customers that have problems in repaying the loans. So we act more like collaborators and partners in a loan rather than the institution and the customer in order to find the final solution for both parties. We don't have any interest to keep the loans in delay. Our interest is to get the liquidity back and to continue to be active in financing. But the human resources, the team that we have created in NOAA are with diversified expertise. We have also increased the team, the technological team, in order to deeply go in IE, in data scoring, in the BIs and all these things that can help us to take the right decisions and to go to the customer with the right products.
Daniel, Hoyola's mentioned a lot of uncertainties there. What challenges does that present you as an investor in companies, in other microfinance companies?
I think the key word would be education. So really informing clients on how we source the investment opportunities, how we assess them on the ground, both from a credit risk perspective, but also from a social impact perspective, making sure we really select the right partners in each countries. So that is really, it requires to go that extra mile. But I think we also try really to bring that transparency to investors by bringing our investees also in front of our clients so that they can really understand where the money is going. So having NOAA today in London is a great opportunity for investors to really understand, from the ground where the money is going, how they are organized, and how they really do business in the countries. We do that also through our seminars, quarterly seminars, but also we bring investors on the ground with biannual field trips where they can really meet with microfinance institutions, but also with end investors, an individual, a micro-entrepreneur, or an SME.
Hey, Yola, how important is the development of technology in microfinance?
In the recent year, it has become very much important because, as I said, the demand from the customer has changed, and now also the clientele is changing. So we are having more and more new generation applying for loans. So they want fast products, they want to be served on the moment they have the need, and also they want to be served not in the queues of a normal institution, so to wait outside. So the microfinance institutions have been obliged to change the way they operate and provide the services. So now the majority operate with the loans in the field. So they go to the customer, not the customer coming to us anymore. The customers apply through the website, and we try to provide the loans in distance as well for them. The core thing is to provide the money when they need it, so fast, be fast. When they need the loan, they need to get the loan. And this requires investments internally in the company. So you need to invest in systems. We need to create the databases. You need to raise the scorings. You need also to apply the logic of a risk in these scorings. So investments, first of all. Human resources training, because to serve to those very demanding customers, the resources in the company has to have the same mindset and to think the customer is the king. So they have to serve to the customer at the moment they need it. So training a lot recently on the digitalization. From the other side, we see also the risk of the data. So investments a lot in security and IT security, especially on protecting the data is required, because the more we get digitalized, the more vulnerable we get from the risk of flowing out of the data. But in overall, I think technology is helping a lot microfinance, apart from the challenges, to create internal efficiencies and to be very fast when compared to to the banks, for example, that still are working more on the traditional way, especially in Albania.
Yeah, and I presume for your clients as well, right?
Yeah.
I mean, local farmers need technology to improve their business.
Yeah.
Same for you in Blue Orchard. I presume the technology is aiding your work rather than hindering it.
Absolutely. So already before COVID, obviously, we were almost entirely digitized when it comes to sharing information, and but also when looking at microfinance institutions, we think, as Ariola just said, we think it's really accelerating the penetration of microfinance in different countries. In India, we had absolutely fascinating examples of 100% digitized microfinance institutions that during the pandemic were really able to just continue their business, but also sharing information with individuals around COVID. So it was way beyond just financial services, but really communicating and staying close to their end clients. So really great examples of how digitization is actually having a high social impact.
Yeah, well, I mean, you mentioned it there. I mean, where are we today in terms of microfinance and financial inclusion in the frontier worlds? That's to you, Herein.
In fact, for the microfinance and the financial inclusion, we see more and more. In fact, we were expecting the financial inclusion to be higher year by year through all the efforts that are performed from all the financial systems. But especially after COVID and in the last year, when the economic crisis hit again the markets, the financial inclusion is expected to decrease, because the demand for loans, it's increasing, but the offer, it's not coping on the same way. So these are also some estimations, even for the European countries, made recently from the European Commission. So we think that there is still a lot of job to be done in the financial inclusion. Emerging markets have also a different behavior, completely a different behavior, because naturally there the financial inclusion has been low so far. So in Albania, we came from a post-communism country in 1990s, and still the financial inclusion has been a problem for many years. Currently, it is 40% of the population without any a bank account. So there's quite a lot of job to be done, and microfinance the institutions are the only one that can reach to that population. So these are people that live in rural areas, distant from the bank branches. So we go there. So and it's our job. However, I think it's quite a long path to go and to decrease as much as possible the financial inclusion.
Okay, that's brilliant. So that is how microfinance works on the ground. In the final part of the show, we're going to answer the question probably most investors want to know. I mean, how does the investment performance work, certainly in the future? So my first question to you, Daniel, what's the role played by microfinance in investors' portfolios?
So by choosing a pure private debt microfinance strategy, you can definitely add a lot of diversification, because those are the type of risk you wouldn't find in any other private debt strategy. So this is really creating a lot of diversification for any portfolio, aside obviously of the social impact. So we even have investors that like the social impact, but they really choose microfinance debt as a way to diversify further their alternative investments. What we've seen over 20 years is really the great resilience of the industry, and the low default rate and the steadiness of returns that are uncorrelated, not only to public markets, but also to the noise that you might have at the country level. So you see that because they are financing sectors like agriculture, the small economies of those countries, which are lowly correlated to the noise that you have at the country, you see actually this great resilience of the industry. And that's what we've seen in any really type of black swan events. We've seen really a great resilience of the industry.
I suspect most people will hear the word impact and microfinance and immediately think high risk. But from what you're saying there, that's not necessarily true.
That is true. Again, we, in our flagship strategy, we really focus on the higher end of the industry, the larger, the more mature microfinance institutions. And obviously, they are more resilient. And I think with a good selection process, you can really partner up with financial institutions that are resilient, can cope with problems ranging from the pandemic, from inflation. So yes, I think it is resilient. And by looking at just the risk-return profile of those type of investments, we think it is interesting.
Hirola, I just want to go back to microfinance in Albania. What is the outlook for microfinance like in Albania?
We have quite a positive outlook for the microfinance in Albania, exactly because the market still remains very small. The majority of the enterprises, 94%, are very small companies, 1 to 4 employees. The farmers have still very small pieces of land, so the need there is for small loans. And from the other side, also the need for financing from the families, especially if we consider a new couple to buy an apartment. So the amounts are the normal small amounts for buying and for refurbishment. From the other side, we see a tendency of the banking sector to merge. From 17 banks in 2015 in Albania, now there are only 11. And the banks are taking care of setting up the operations only in high populated areas. So they want to target the number of the population. So they are withdrawing with the branches from the rural parts or the small cities of Albania, which creates a more, I would say, opportunity for microfinances, because these customers as well have to continue to be served with financial products. So while banks are shrinking to the centers of the cities, we go more deeply on the closer to the customers with the capillary penetration of our branches and of our people. Albanian economy remains small. As I said, informality, it's on the way to reduce, but still it's considered high. We have quite a high number of population not having a financial product, like 40% of the population. So the market is there for us for the future. So we see ourselves in 5 to 10 years still to grow as a market itself, which has been also the history of the last 10 years, because we can serve that market. So we are the response for that market.
And Daniel, is that replicated further afield as well? Do you see the similar picture?
Yes,
globally?
Yes, definitely, absolutely.
Okay, and just for a wider group of investors, why should financial inclusion matter to investors? Daniel, I'll put that to you first.
Yeah,
because there'll be a lot of people that just think about returns. Why should the inclusion matter?
Yeah. So as said, from a pure portfolio management perspective, having a broad exposure to different credit risk from microfinance institutions across EM is definitely giving you diversification, is certainly helping to improve your efficient frontier. On top of that, you have the social impact that you are generating that is there, and we can report to you the type of social return that you can actually generate. You have, through your partners, you will be able to generate jobs. You'll be helping to include the excluded, and that is often, largely women that are excluded from the financial sector. So I think, good risk-return profile plus social impact.
And Herola, same question, but slightly different. You came from a banking background, right?
Yeah.
So what made you go into the microfinance side of things?
In fact, I jumped to the microfinance in 2014. It was exactly in the period when the worldwide crisis, 2009-2010, has hit the Albanian market. So the banking system was not aggressive and was not expanding. The whole system was in a standby situation. So the majority of ourselves at a young age couldn't feel good just to stay in an office and not serving to the customers, not providing more services to the customers in the market. And the microfinance was the alternative way. So microfinance at that moment saw the opportunity and started to jump and to provide more services to the market. So I liked a lot the dynamic, the energy, and the most important thing is in microfinance we see the impact, because we see the customers growing up. We see the people that have a dream to realize, like starting up a new business, especially women. In Albania, we are very much focused on supporting financially the women that are trying now to create financial independency in the market and create an alternative income for the families. So we see that impact day after day, and it gives you a pleasure and satisfies you finally with the work that we do there. And yeah, that was the reason that I jumped from the banking sector to the microfinance.
And that's also the reason why investors should care, right?
Yeah.
Absolutely brilliant. Thank you very much, Herola, for joining us. And Daniel, thank you so much.
Thank you for being here.